What's happening, everybody? It's your boy, Sean McLaughlin at Options Sean on Twitter X. I'm talking to you as the market is screaming higher right this second. I don't know if some news just broke, but anyway, today is October 19th, 2023. This is the All-Star Options Jam session where we review portfolio activity this week and any positions that we have on, if we've exited them, if we've made any adjustments, if we're updating stops. All that stuff gets covered in the Options Jam session. But before we do that, I have to drop the old lawyer disclaimer. Everything we discuss here is for educational purposes only. I'm showing you what I'm doing with my money, and I hope that you learn something along the way. All right, so let's get into it. Here's a chart of the S&P 500. When you look at the S&P 500 chart, especially with this trend line drawn in here, it doesn't look like it's too concerning. But the market is feeling like it's at a precarious level, and it'll reveal itself more when we get to the IWM chart in a moment. But this is where we're at in the S&P 500. Still, I'm not getting aggressively bullish here. I've been a broken record for months now. Doesn't feel like the right environment to be getting aggressively bullish. Generally speaking, I want to be delta neutral, or at least if I'm getting bullish, I want to be cautiously bullish. So that's where we're at. Here's the volatility index, VIX. Still tends to be a little bit rising. We've been flirting with the 20 level. 20 level is a key level to pay attention to. Usually in the olden days, as they used to say, when VIX was above 20, that was kind of the red alert for the markets. As you can see in this chart, VIX has been higher, sustainably higher for a long time. But traditionally speaking, 12 to 20 is the bands that VIX would tend to stay in. 12 would be a kind of a calm market, and 20 would be a scary market. So we're flirting with 20 now, something to be mindful of. All right. So let's get into positions we've exited this week. And the good news on these exits is it sucks to exit and it sucks to give back profits, but these two exits are profitable exits. First one is Carrier Global, ticker CARR. This is a trade we got into on July 10th. We bought calls. What calls did we have? Apologize here. They should be on the chart and they're not. We bought the December 55 calls, and we paid $2 for them. Well, the plan was that if Carrier got up to 59, that we would sell half of our position and lock in some profits, and that's exactly what we did. When we got there on July 28th, we got above 59. I sold half of my calls, and I got $6.70 for them. So I paid $2, right? $2 here. I sold half of them for $6.70, so I locked in gains right there. And then yesterday, Carrier closed below our updated risk management level. We raised our stop, a trailing stop below this low here, and I alerted you guys about that previously. Unfortunately, we got stopped out. The Carrier closed below our level, which was 52 yesterday. And so we exited it this morning. And what did we get? We got 95 cents for our remaining calls. So we got 670 up here and 95 here. All in, it's a profit, a nice profit. We will take it. All right, next up is Caterpillar, Caterpillar, similar story. We bought calls back on May 17th. We bought the November 240 calls. In this case, we wanted to sell half of our calls when we've doubled our money. And in this case, we did about 3 weeks after our entry. During this run up here, we were able to sell half of our calls for $15. All right. And that basically gave us a free ride on the rest. And it was a pretty good free ride. We gave back a bit. And yesterday, Caterpillar closed below our updated stop. And we exited today the remaining half for $21.65. So a very nice profit, $21.65. That's pure profit for us. So that was a great trade. All right, next up is Merck. Now, we are still in Merck. These next two trades, in fact, intraday, they triggered our stop loss levels. Now, you guys know, if you've been following me for a while, I don't like to exit intraday. I like to wait for a closing price. And if the stock closes below my risk management level, then I'll exit the next day. Our risk management level on Merck is $100. We traded below it today. So we're going to keep an eye on this one. If it closes below 100, this is a short straddle. We will exit it today or tomorrow morning if we're still below 100. Same thing with Russell. We are in a risk reversal. I'm sorry, we're in an iron condor. And 170 is our risk management level. We've flirted with 170 a number of times, as you could see. We've had intraday trades below 170, 1, 2, 3, 4 times. But in every case, it closed back above 170. And in fact, IWM is back above 170 as we speak right now as the market is rallying. I'm waiting for a closing price. If it closes below 170, I will get out. Otherwise, we'll keep holding this iron condor and keep working for our profit target. All right, I got a couple updated stops for you here. This Chevron trade, this is leaps. This is a trade we got into way back in February 2022. Feels like a million years ago. We've been in this trade for a year and a half now, but we're starting to close in. January, this January is when these calls expire. We are along the 150 strike calls. We got in back on February 2nd of 2022. We sold half, as was part of our plan during this run-up, and we've been free riding ever since. We keep moving up our stops. Our stop now is at 155. If we break below 155, that'll be my signal to exit this position and book our profits. Google is a little bit more interesting situation. I apologize for this chart. This chart only shows one trade. We actually have 2 trades on in Google. This trade that it's showing right here is the long December 120 calls that we got into back on May 3rd. We sold half on May 11th. We're free riding on that trade. We also have an additional trade in Google. It's a risk reversal, a March 125, 150 risk reversal. Both are working. But the update here is it's kind of hard to see, but I've updated my stop to 125, and that's for both trades. So for both the risk reversal and the long calls trade, 125 is our risk management level. If Google trades below 125 for either of these trades or at any time, we're going to close both of these trades. They're both bullish bets. They both have different risk profiles. But if you're following along with one or both of these trades, 125 is the level that we're going to act. All right. New trades this week. I won't get into the details here. You can find these on the blog, allstarcharts.com. Head to the members section, look for options. We put on a trade in U.S. oil on Monday, delta neutral trade. Our bet is that USO is going to kind of stick in this sideways range for a little while. And Bank of America, we put this trade on yesterday. This was a bullish risk reversal. This is a trade available to everybody. You can find it on the blog. I find it also on my Twitter stream. But we shorted the 25 puts and bought the 30 calls in January. And this is one of those trades that we're either going to know right away that we're wrong and we're going to get out if we lose 26, or we're going to take some profits. We're going to get out if it trades up to around 32. So this is really just more of a tactical kind of a whipsaw bet. We're not super bullish on Bank of America, but we smell an opportunity. So that's the trade. You can get all the details on the blog, like I said. All right, folks, any questions at all about anything you saw here or just anything at all about All-Star Options or All-Star Charts? Shoot us an email, info@allstarcharts.com. Happy to help. In the meantime, thanks for tuning in. We'll be back next Thursday with the All-Star Options Jam Session. Until then, trade them well. See you soon.